Okay, we're getting ready to do personal finance, chapter 18. It is about saving for retirement, and the earlier that you can do it, the better. We've got the financial calculator ready to go because we'll do a little bit of time value of money. I'm going to go through these kind of quickly because I've already gone through the first three with the ones that are here in class, but I want to make sure that you've caught this. So before you start saving for retirement, it's a good idea. If you go to a financial advisor, the first thing they'll have you do is sit down and fill out a questionnaire, and they'll calculate your net worth. Okay, so they'll want to know what's your situation, what's your current financial situation. So you got to know what that is in order to start planning for later. So how do you get net worth? You take assets and you subtract the liabilities, right? So if I put a negative here in my screen, didn't like it. You subtract the liabilities. Assets are what you own of value. Liabilities are what you owe or consider debt, and you simply subtract. So in this problem, I think they changed problems on me. No, they didn't. This stayed the same. All right, so what we have is $215,700 in assets. You subtract $25,300 and you get net worth, which is what is left over, of $190,400. Okay, that is correct. Okay, number two, we're going to keep going just a little bit more on this net worth. And this time we're going to get some numbers that we got to add up for the total assets and liabilities. So we've got a car that's worth $48,000, $375,000 is the house, checking account with $900 in it, savings account with $2,900 in it, a mutual fund, which is an investment of $190,000, and personal assets are worth $80,000. If you add all those up, you get total assets of $696,800. Then if you add up the three liabilities, right, the car loan of $35,000, the mortgage of $250,000, and the credit card balance of $1,900, there are total liabilities of $286,900. So bless you. So if you subtract, bless you, from your liabilities from your assets, there's the calculation here on my spreadsheet, and you would get net worth of $409,900. Okay, so that should be hopefully pretty straightforward. What would make this problem difficult is if they mixed all these up in the order that they told you, and you'd have to go pick out the liabilities. So they don't do that. I think they usually do pretty good on that. All right, number three. Another thing you're going to need to sit down and look at before you start planning for retirement is when you are older, what is the amount that predicted that you're going to spend on housing if you have a certain income, all right? So our income in problem 3 is $53,000. If you go to this exhibit 18.4, this exhibit is for people that are age 65 and up, okay? 65 and up. And if you look at this pink area here, you can expect to spend about 35.6% of your income on housing. This is up. The last time I did this, it was 32 something. So housing has gotten more expensive, right? And there's only so many. This is your whole pie, right? When this piece gets bigger, guess what happens to one of these pieces? They get smaller. Yep. So it's not like you magically have more income. You could increase your income, but you'd probably have to go work at Walmart or something, you know, as a part-time job. In fact, I think a lot of people that retire are going to have to end up working a little bit somewhere. So 35.6% of the annual income So it comes down to the fact that we will spend $18,868 on housing. And that is 35.6% of the total annual income. All right, so now we're caught up. Now we're ready to move on. What else should we be looking at? Okay, what else should we be looking at as we're starting to think about retirement? So you need to think about how much health care is going to be predicted to be, right? So that same income that we just had, let's put it in this one, which was 53,000. Our exhibit is for someone who is 65 and plus, right? And now let's go back to that exhibit. And this is going to be healthcare. Healthcare has jumped. It's jumped to 13.2. Last time I did it, it was 12.2. Okay, so let's put 13.2 in here and see what we get. 13.2% is $6,996 on healthcare a year. That's just an average. That's just a prediction. Doesn't mean that's what you're going to spend. You may spend more than that, depending on your health, right? So, okay, so let's put $6,996, which, one more time, is 13.2% of that annual income based on that exhibit that they have given us there. Okay, so that's a lot, right? Just on housing and healthcare alone, right? If you add up both of those, so 35.6 plus 13.2, that's 48.8% of your income spent on just those two things. So that's almost half of your income. So you say, is that good or bad? I don't know. Depends on how much income you have. All right. Now let's go back to some old time value of money calculations, right? Time value of money calculations. So we're going to use the calculator. We're not going to use the table, okay? Because I don't trust that they have the solution in for the table. So sorry that that has gotten that way. I'm just going to take that out. Okay, Jamal graduated from college. His parents gave him $1,000 and told him to use it wisely. He started a retirement account. I don't know very many college students that do that, but they started a retirement account. If he puts that in an IRA, which is an individual retirement account, that earns 11%, okay, that's the return on the investment, that 11%. How much will be in there in 10 years? Okay, he doesn't deposit any more money, so this is a one-time amount. Remember that? One-time amount gets put in as your present value. Okay, so $1,000 check, and it's earning a rate of return of 11% for 10 years. I'm going to go to the calculator and put our information in. It's been a little while since we put this in. We're trying to find its future value at 11% for 10 years. Be sure to change that to annual. So we're looking at, woo-woo. You say, well, I've doubled my money. Yes, you've almost tripled your money. It may not seem like a lot, but it's more than you had. Right? So $2,839.42. Okay. I'm going to do one thing to this. Let's go put it in first. So the IRA balance based on our table, I'm sorry, our calculator, right? Let's just for fun, I want to do something with this a second, if you don't mind. So let's say this is a college student. So let's say you're 25 when you graduate college, whatever. Let's do this for 40 years. Let's just see what it does, right? Let's do this for 40 years, not just the 10, right? And you're gonna see some pretty good magic of what they call compounding interest, at least I believe. And this is not putting any more money in, right? Not putting any more money in at all. So let's see. Hey, that's not too bad. Did you see that? Putting that $1,000 away at age 25 at an annual return of 11%, it would grow to $65,000 by the time you're 65. So to me, that sounds better than that 10-year future value. So like I said, what happens is, yeah. So anyway, that's that. All right, we'll go back to the problems now. Keep it going. Number six. So Kayla has a good job. She estimates she'll need $875,000 in her total retirement nest egg. Okay, total retirement nest egg. And this is number 6. Okay. I'm not sure what happened to this one, but maybe they took it out. All right, so we'll just name this one number 6. Because I think this is how it's going to go. So if you think you need a certain amount in a nest egg. Oh, nope. That's okay. That 7 moves on. 7 builds on 6. Okay, 7 builds on 6. All right, so all in all, she's hoping to have $875,000 in her set aside in total for retirement. She's going to do it in 3 different ways. Okay, it says, so she estimates she'll need $875,000 in her total retirement nest egg by the time she's 65 in order to have retirement income of $20,000 a year. She expects that Social Security will pay her an additional $15,000 a year. All right, so she's going to count on having $20,000 a year plus the $15,000 with Social Security. So she's hoping to live on about $35,000 a year. If you have your house paid off and you have money saved, you know, a retired person without a house payment or something might be able to do that. So we're going to work on this $20,000 of retirement income. So she currently has a $5,000 amount in an IRA. It's an important part of her retirement nest egg. She believes her IRA will grow at an annual rate of 8%, and she plans to leave it untouched until she retires at age 65. So this is kind of like the one we just did of the $1,000 of the person who put that college gift away. So this time our present value is 5,000, and she is 25 years old, right? It's going to grow at 8% for 40 years. Okay, it's going to grow at 8% for 40 years. So this is just 5 times more than that example we were just looking at. So I have a figure here. Let me make sure it's right. Let's put it in the calculator. So she's got $5,000 already in an IRA. Okay, it's already there. She's not planning to add any more to it. She's put it where it hopefully will earn about 8%, and she's looking at 40 years into the future. There it is. So she's looking at $108,622.61. So that's part of her retirement. So here's the deal. Let's do this on the board a second. This is how much she wants to set aside for retirement, right? Most advisors will tell you to have at least 3 legs of something going on to raise this money, right? This is her IRA, right? So this IRA that she's putting away and gonna leave it there at 8% for 40 years, how much is that going to produce of this money? So it looks like she can estimate 108,622.61. Okay, well, that's not a whole lot of that. Yeah, I know, but it's part of it, right? It's part of it. So let's put that in. So the future value of just the IRA is 108,622.61. Okay. So that's one leg of her retirement plan. Okay, the next one is the same problem, but now, okay, so once again, here is her total retirement nest egg that she wants to have set aside. Here is, and this is the one that I've been told is not grading correctly. Okay, so let me see what we got here. So now, what does it say? How much money will Kayla have to accumulate in her company's 401k plan over the next 40 years in order to reach her retirement income goal? Well, let's look here. What is this? This is 108,622.61. Now, why did I round it to 108,625? I have no idea. It's pretty close to this. What do they tell you? Do not round intermediate calculations. Round your final answer to the nearest whole number. Well, that ought to be 623. Do you agree with that? 108,623. Okay, 108,623. For some reason, I put 625 in there because I wonder if this thing was misgrading. Here is how much money, if she wants that total of 875,000, this is how much she's going to have to accumulate in her 401k. 401k. So she's only going to have two legs, okay, to make it to this. Okay, so if we put in the 7.
Was it not 108?
Well, it says round it to the nearest whole number. So when we calculated it on the future time value of money calculator, wouldn't the nearest whole number be
108,623?
Yeah, and that's what
103.
108,623,000. Isn't that right?
Yeah, down there you wrote it as 103.
Okay.
63.
Okay. Let me go back. Oh, I wrote it on the board. Okay, sorry about that. Okay, so we're going to round this to 23, and we're going to subtract this 108,623. So then this should be the difference, and that's what they want. They want some idea of how much she needs to build in her 401k. So 771,377. 771,377. I have a feeling we're going to get a red check mark because I think 771,377. Because I don't think they followed their own rule. Yeah, they didn't follow their own rule. Let me put in 375. I don't know why they did that. Okay, so let me put it in, but I had just one more time. I'm checking it again. It didn't answer it correctly. That's what they were complaining about. Okay, 771,375. Let's put that in there. Nope, that's not it either. Okay. Interesting. How much money will Kayla have to have? 771,375. I can't remember what I had in there before. Let me go back. Just a second. Okay. Oh, 766,375. Why did I have that? Okay.
You miswrote it as 103. It's 108.
You're right. Ada, I hear you now. Sometimes I can't hear what I need to. All right, 108. 623. Okay, so now for some reason I put in 108,325 the last time I did this. 766,375. Is that true? 766,325. Let's see if that's right. It's not right based on what they're telling us. But I think I put it in here. Nope.
I got it correct when I put it in.
You did?
Hold on, let me pull it back up.
Okay. Let's see what I'm doing wrong. Probably not paying attention. Okay, hang on. Okay, I don't mind. Okay, so one more time. 108,622.61. 108,622.61. That's the 5,000 at 8% for 40 years. Okay, is that correct? And that was the previous one. The previous one, this is good. 108,623, right? And wouldn't you just subtract this from the 875,000? I would think so. That's how I see it. So just
I put in 766,375 and it was correct.
you put in, okay. You put in 766,375?
And it was correct.
Okay. Like I said, I put that in there for some dumb reason. Okay. Okay. All right. Put that in. I don't know why it is. And that would have to make the IRA balance be 108,625. So, yeah.
See, I put 623 for that one and that was correct.
You did?
Mhm.
108,623. Now let me try it here.
But like,
You put that in?
no, sorry, I put the 108,623 in for the previous
Right.
question and that was correct, but
Right.
then for the next question, it wanted the 5.
No, that's dumb. Okay, that's what it should be up here, right? 108,623. So if you subtract it, you should get that. So they're off what, $2? Okay, well, I'll make sure that online knows because I'm recording this now. Okay, so if you want this with a green check mark, put in 108 235. What am I doing? 108,625. That's what they're I think that's what, nope, 108. I can't read right now. Just a second here. 625. That's what they're saying the IRA is. So this is not matching what they told us here. I know it's off $2, but it's not right. Okay, so this is not matching number 6. Because you should be able to just put this number in right here into this problem so that it would subtract from 875,000. But so to get it right, go ahead and put in the remainder. So just to get it right, I've got to send them a message. All right, so here is the amount it should be. So I recorded this wrong. I'm sorry. So we've got 7,666,375 is how much she's going to need. That would have made this. What if you put this in that number 6? I'm going to see if that is correct. I'm going to go back one, just a second. Just trying to see what they're doing. 108. See, they used to have a lot more leniency for a range because of rounding and stuff, but okay, see, they accept that. They also accept the 3. So let me go back. I don't know what the range is, but what does this one say? This one just says to the nearest whole number, not to the nearest 5. It's the nearest whole number, so 623. So yeah, they just
Six
didn't.
also accepts 51,367.
6 home.
So it also accepts what?
51,367.
For number 6?
Yeah, and then you can put a 922,633 on number 7 and it accepts that, and it equals to that 974.
Hmm. Oh, okay. Hmm.
Oh,
So-
never mind, I did the algo problem.
I was gonna say, I think that's an algo problem, and that's okay. It's good to know that that's working.
Because I did the wrong problem.
No, it's okay. So the algo one is working okay,
Yeah.
but this one isn't.
I was about to say, I was like, I don't know these answers. I pulled up what I'd already done and I was like, oh, I did the algo.
Okay,
Well,
well,
I've done the algo for both of them.
but whatever we do, whatever we put in 6 should have the calculation of subtracting that amount from 875,000 and it should be right. See what I mean? So-
Did that
so-
for 18 and 19, so
Well-
static.
Well, you're ahead of the game. All right. So I've got this on video now. So if you want it to answer correctly, put 766,375. I think that's the only one that it will take for our static problems, okay? If I go down $1, if I go down to 374 or 370, hang on. If I go, let's just see what happens. Okay, they accept 376.
What's
Okay.
7's answer again?
7's answer is 7's answer is 766,375 or 766,376. I'm just going up one more number just to see. Huh, now it accepted that.
6.
It's not following its own. Sorry, I'm just checking it here. It still took that one. I don't know what it's doing.
Being weird.
It's got some tolerance to it, but it doesn't seem to match up what we were imagining. So, oh, well, okay. Well, any of those numbers work. 766,375 to 766,380 works. So what? Okay. But if you do this, 108,623, you get 766,377. Now let me just double check. 766,377. 766,377. 766,377. Now it did take it. Maybe I was just keying it in wrong. Which is probably what Ada's been trying to tell me for the last 30 minutes. Now that's weird. Okay, all right. I probably keyed it in wrong. All right, so here's what you need to do. I think. So once again, she's trying to have a total nest egg of 875. She's got 5,000 for number 6, she's got 5,000 in an IRA. When it grows at 8% for 40 years, we calculated that on the calculator of 108,622.61. You round it up to the nearest dollar. To me, the nearest dollar is 623. And when you subtract 108 minus 623, hang on, I'm going to do this a little different just to see what's happening here. So 766,377 does seem to accept it. 766,377. So you do have to make sure that you're filling things in correctly. So there you have it. There you have it. So I guess it's grading okay. Is everybody else okay? I don't know. I must have just, yeah, you're right. I keyed something wrong. So anyway, onward we go. Onward we go. Okay, we'll probably do 19 on Thursday along with starting our review, okay? Or let's see what we can do. All right. Future value. All right, so here's what we're doing for this one. When you're trying to build a 401k, you have to come up with how much you should be putting in it to build it to a certain amount. So calculate how much you would have in 10 years if you saved $2,000 a year at an annual rate of 10%, with the company contributing $500 a year. So we're putting in 2,000. The employer is matching, right? That's a match in a 401k. They're putting in a contribution. So the contribution total is 2,500. Okay, so we're going to put that in every year. So this becomes the future value of an annuity. We've got 10%, and we're looking at 10 years into the future. Okay, so like I said, I'm taking out the stuff out of the table. So basically, money is being put in there of 25,000 in total, because they're putting that in there 10 years in a row. So let's go look at it from, make sure it's right. So this becomes a 0 because you're putting aside 2,500 a year annually at 10% for 10 years. So this future value would be 39,843.56. Okay, and then did they say they want you? Yep, round to the nearest whole number. I'm going to put this all in here and see what it does. 39,843.56. And I'm going to see if it, yep, it rounded it for me. Is that right? Yes. Okay. So you have to remember to combine both contributions. And that's how you build money faster, is if your employer's helping put money into your 401k or something of that nature. Okay, so let's go back. Bring this back over here. All right. Number 9. Okay, number 9. We are, assume your gross pay for your period, for the period is $2,000. Assume your gross pay per pay period is $2,000 and you're in a 33% federal income tax bracket. Calculate your net pay and spendable income if you save $200 per day, per pay period after paying income tax on $2,000. All right. So here's the amount that you are getting paid per pay period. They're going to withhold 33% taxes. Now, for the record, this is not how federal income tax is calculated. They're just using it as a flat tax for simpler calculation's sake. So we're going to take 33% of $2,000, right? Yep. And we get $660. That's going to be your taxes that are held, right? So when you subtract the 660 from the 2,000, you get net pay of 1,340. Okay, 1,340. But if you are real serious about saving the $200 per pay period, you'll subtract that from your net pay, and then you'll get your spendable income. All right. So the spendable income is taking into consideration how much you're trying to save. So you really ought to look at your spendable income minus being what you're trying to save, right? That way you're not counting that, you're not counting on spending that $200. So that's what they're trying to communicate here. They're trying to communicate treating savings almost like a bill, right? You pay yourself first. You probably have heard something like that before. So let's see if I'm right. I think I forgot to check it. Just a second. Check the work. We're almost done. Okay, check the work. Yep, that's good. All right, let's do something else here. Number 10. Okay, assume your gross pay per pay period is $4,000. Okay, we've got that there. And you are in the 33% tax bracket. Calculate your taxable pay and spendable income if you have $400 per pay period in a tax sheltered annuity. What it means to have something that's tax sheltered means that it hasn't been taxed. Okay, a tax sheltered annuity means you can set aside money into this annuity before it gets taxed. Okay, before it gets taxed. So we're going to subtract the $400 from the gross pay to get what's called taxable pay. So a lot of your healthcare benefits come out of your gross pay before your gross pay gets taxed. Okay, so we've got $3,600 as our taxable pay. And then if we take 33% of that, then we get $2,412 when we subtract the amount of tax. Okay, so one is subtracting the amount you're setting aside before your tax. That's called pre-tax. The one we just did in number 9 was post-tax, after taxes. So the spendable income becomes $2,412, but they're looking at two different pays here, so that didn't help. Okay, I mean, they should have looked at the same pay in 9 and 10, and then you could compare it, right? Yeah, they didn't use the same pay, they should have. So I'm going to use the same pay for just a second here. I got to get this back. So just for fun, I'm going to make it the same pay and the same amount of savings. Okay, so the same pay, I'm going to throw the pay in here of 4,000. I'm going to take 33% of that, which leaves us with the net pay. And if we were saving the same amount, then our spendable income would be $2,280. Does everybody see that? This is from 9. Then on 10, we would be comparing apples to apples. Same gross amount. Now this gross amount of 4,000, the 400 gets set aside before you're taxed. So which do you have more spendable income? It's setting that savings aside before you're taxed. You actually have more spendable income. They should have made those exactly the same so that you could see the difference, but they didn't do it. So anyway, I'm going back and putting this in so I don't screw up myself the next time I do this. Okay. I think we need to get a hold of them and make us part of their group that decides on problems. All right. 11, you have 80,000 in your retirement fund that's earning 5.5% per year, compounded quarterly. So we're not going to use the time value of money right now. We're going to use a table that they have. How many dollars in withdrawals per month would reduce that nest egg to 0 in 20 years? Okay, so let's put $80,000 and our interest is 5.5%. And I need to change that to a percentage, not a dollar amount. So hang on a minute. 5.5%. No, I don't want it 6. There we go. How many dollars? So what you have to do is pay attention to this exhibit. Okay, so what did they say? How many dollars in withdrawals per month would reduce the nest egg to 0? You would use up all your money, right? If you'd use up all your money. Now, what you've got to watch is how much is in. All right, so we've got $80,000 and 20 years. So you go over to the time length and look what this table says. This table is saying you can reduce your nest egg to 0 by withdrawing this much each month for the stated number of years. So they've got 80,000 for 20 years. And this is based on an interest rate of what? 5.5. So So you could withdraw a month from this $80,000 of the nest egg, you could withdraw $544 a month. And by the time 20 years are up, you better be dead. That's terrible, but you better be dead because there won't be any more in the nest egg. That's what they're trying to get at, all right? Trying to help you understand. Now that's just a table. You can get a lot more precise, right? So I'm going to put $544 if you don't want anything left in that nest egg. If you don't want to leave anything to anybody, it's your money, you want to spend it. Okay. All right, so now let's look at this next one because it's similar to this, but this is saying the same information over the same timeline. But what if you want to leave the 80,000 intact, right? You want it there to be an inheritance to your kids or whatever. So one more time, it's 544 here. If you don't want anything left, you want, and now we go to that same table and look on the end of it, or you can withdraw this much each month and leave your nest egg intact. How much each month? You could withdraw $368 instead of $544, and it will leave that $80,000. They call that the corpus. The corpus of a nest egg is the amount that's sitting in there, and you want to oftentimes try to leave the corpus alone. So leaving the nest egg intact, $368 is how much this table is telling us. Okay, so let's bring that back over here. And then we'll do chapter 19 on Thursday because it won't take very long. So 368 is the answer for this one. Okay, 368. All right, that's it. We'll do 19 on Thursday. It'll take maybe 10 or 15 minutes because it's all about estate taxes and if you're a wealthy person when you die, there's a certain amount that you can have and it won't